China's peer-to-peer lending fraud. China's booming economy over the last few decades gave rise to a new way for unscrupulous business practice called peer-to-peer lending. On the surface, it seemed like a legitimate practice where private investors with money could make a decent return while helping out someone who needs extra cash. The problem came when the middle began to cook the books and not conduct risk assessments on the borrowers or use investor funds for other purposes. As the allure of high returns clashed with the limitations of online lending, fraudulent schemes like eZuBao emerged, leaving investors devastated and questioning the true nature of credibility. Hello, and welcome to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. Before we start, make sure to leave a like, subscribe, and comment below if you enjoyed watching this video, and turn on the notification bell to keep posted. And now, without further ado, let's start. While society as a whole has progressed, so too has the scope and complexity of financial scams. When fraud becomes too appealing to pass up, industries spring up to take advantage of the gullible. In the early to mid-2010s, the internet's wide acceptance in China sparked a boom in the country's IT industry, providing an ideal environment for proactive business owners. Peer-to-peer lending systems, which allow individuals to engage in direct lending and borrowing with one another online, have emerged as a key innovation with the potential to challenge the traditional banking system. Rapid growth in the business led to more than $200 billion in outstanding loans by 2015. The disturbing truth, however, was that almost all of these sites were scams masquerading as legitimate ones. As a significant participant in the P2P lending industry, eZuBao was revealed as a Ponzi scam in 2016, leading to massive investor losses and public protests. The government's response was a severe regulatory restriction that the whole peer-to-peer lending market was virtually banned. As a result of this catastrophe, preventative measures were taken against related industries, such as stopping Ant Financial's IPO in 2020 and outlawing cryptocurrencies entirely in 2021. Before the rise of P2P lending in China, the country's banking sector was dominated by state-owned banks recognized for their stringent lending standards. This method made it extremely challenging for startups and people with bad credit to get a loan. This stunted economic expansion since most small and medium-sized businesses employ most workers. The government and the corporate sector agreed that liberalizing the financial system and increasing access to finance were urgent priorities. China also has one of the highest personal savings rates, with an estimated 45% of disposable income being saved by ordinary Chinese families. The personal savings rate in the United States was around 6%. Chinese consumers have large amounts of spare funds and are looking for investment opportunities, making China a prime market for online P2P or peer-to-peer lending. Here's how P2P lending operates. Individuals and small businesses prepare profiles on the lending platform and submit their loan applications. They specify the desired loan amount, purpose, and offered interest rate, and provide credit history and income details. Those with extra savings could peruse the various loan applications and choose to lend money to their preferred candidates. The first peer-to-peer lending platforms appeared online in 2010 and quickly became popular. As more entrepreneurs noted the success, more platforms came online, eventually reaching more than 3,000 at its peak in 2015. Total outstanding loan value increased dramatically, crossing the $200 billion mark. The government showed its commitment to the new sector early on. In 2013, China's central bank, the People's Bank of China, published a policy document supporting peer-to-peer lending to fill the gaps left by traditional banking and increase small enterprises' access to financing. Ding Ning was one of the adventurous people to embrace the opportunity, launching eZuBao in 2014 and quickly becoming one of the most prominent companies in the peer-to-peer lending space. To put it into perspective, eZuBao raised $7 billion from 900,000 Chinese investors in only its first year of operation in 2015. They assured investors that the money they raised would be used to provide loans to people and small enterprises that met stringent eligibility requirements, making the loans virtually risk-free. Despite these assurances, their returns were very competitive, at 9 to 14%. Ding Ning knew he had to appear successful and legitimate if he wanted investors to put money into his platform. He used a variety of methods in order to accomplish this. The corporation spent a lot of money on television commercials, especially those that aired on government-funded news networks. As a result, many people mistakenly believed the government had verified and approved the site. Ding also aimed to improve his own reputation. He was a regular at community gatherings, and he even got his picture taken with the Prime Minister of Cambodia. This shrewd maneuver further reinforced their credibility, since most people would presume formal authorization to meet with the Prime Minister. eZuBao used a different approach to luring investors than traditional media by opening physical stores around China. Zhang Min, the company's president and public face, was featured in promotional materials. The company's founder, Ding Ning, met the company's president, Zhang Min, on a dating website called Enzo Noble Gathering Circle. Zhang Min was the face of the firm and made countless media appearances and starred in expensive TV ads despite having no relevant expertise or certifications. It turns out that Ding Ning didn't just meet Zhang Min and other female executives at eZuBao through Enzo. Many people speculated that Ding Ning had intimate ties with all, or at least some of these ladies. Ding Ning also gave these executives lavish presents on top of their already substantial salaries. For instance, he gave Zhang Min a $20 million Singaporean villa along with a $2 million pink diamond. Ding Ning reportedly spent an astounding $150 million on perks for executives and extramarital affairs. One would reasonably wonder where Ding Ning got his hands on such huge sums of money. Is eZuBao actually succeeding, or are there other factors at play here? As things went on, it was clear that eZuBao was a total fake. In its entirety, the corporation operated as a Ponzi scam, with no lending whatsoever being done to either consumers or companies. Ding Ning spent the money as if it were his own, living lavishly. eZuBao went bankrupt and was unable to pay back its investors in December 2015, less than 2 years after it had first opened for business. Protests broke out as tens of thousands of individuals saw their life savings vanish. The authorities found tens of millions of dollars in cash and jewels when they raided Ding Ning's home. According to the company's books, no loans were ever extended. Ding Ning was sentenced to life in jail, and the government took back the remaining property. The victims were only able to collect around 35% of their initial principal since Ding Ning had already wasted most of the money. Ding Ning's decision to run eZuBao as a Ponzi scheme instead of a legitimate platform likely stemmed from the allure of quick and substantial gains. While online peer-to-peer lending held great promise in theory, it presented significant challenges when put into practice. One of the major obstacles was the inherent risk associated with lending to small businesses and individuals with limited credit history. These loans carried a higher risk of default, which made traditional banks wary of providing them funds. With peer-to-peer lending, borrowers submitted their loan applications online and self-reported their income, credit history, and other relevant information. This online nature made it easier for borrowers to engage in fraudulent practices, such as faking their income or identity, to obtain loans under false pretenses. Some individuals would borrow money using fake identities and vanish without any intention of repayment. The comprehensive income and identity verification processes employed by traditional banks were not feasible in the online peer-to-peer lending space. To address this issue, peer-to-peer lending platforms resorted to two main methods. Some platforms became loan sharks, resorting to intimidation and blackmail to force borrowers into making payments. On the other hand, platforms like eZuBao opted for the Ponzi scheme route, wherein they did not lend any money to borrowers, but used the investments from new investors to pay back older ones, creating an illusion of success and returns. By adopting the Ponzi scheme approach, eZuBao and similar platforms could offer significantly higher yields to investors than legitimate platforms, attracting a large pool of investors. This competitive advantage made it challenging for legitimate platforms to attract investors, prompting some of them to resort to fraudulent practices in a desperate attempt to keep up. Regulators in China had a big wake-up call as a result of the emergence and eventual demise of fraudulent peer-to-peer lending platforms like eZuBao. 80% of Chinese P2P lending platforms were engaged in fraudulent behavior in 2016, and the vast majority did not keep consumer funds separate from company funds. Concerned by the eZuBao affair, Chinese officials began looking into other P2P lending sites, resulting in many arrests. The number of active platforms dropped dramatically over the subsequent years, as many were shown to be fraudulent. In 2019, the Chinese Supreme People's Procuratorate investigated how these scam sites duped so many people. They found that these platforms primarily use 4 strategies to give the impression that they are legitimate: employing celebrities as paid spokespersons, sponsoring charitable and social functions, partnering with state-run businesses or publicly traded organizations, and making false claims of compliance with government rules and regulations. These techniques were developed to make users feel more confident in giving platforms with celebrity endorsements or major corporate partnerships a go. Interestingly, this playbook of using these methods to create a false sense of legitimacy was not unique to China. Fraudsters in the United States, such as FTX and Sam Bankman-Fried, adopted similar tactics. They engaged in public appearances, such as testifying in front of Congress about crypto regulations, to create an impression of regulatory compliance. FTX also spent substantial amounts of money on A-list celebrities appearing in their commercials, further enhancing their image. The example of the fraudulent hydrogen truck company Nikola also showed how partnerships with reputable companies like General Motors were exploited to create a mask of credibility, even without significant due diligence. In both China and the United States, these tactics played on the natural inclination of people to trust and associate legitimacy with well-known names and entities. However, this trust was abused in many cases, and due diligence was lacking, leading to significant financial losses for unsuspecting investors and the eventual exposure of fraudulent schemes. Indeed, conducting comprehensive background checks on every advertiser, partner, or spokesperson is an arduous task, particularly for media outlets and companies dealing with a multitude of advertisers and partnerships. This in turn provides an opportunity for fraudulent actors to exploit the system, making it imperative for regulators to remain vigilant and enforce appropriate checks and balances to protect consumers and investors from such scams. Hi! We hope that watching this video was interesting and that you learned something valuable. If you enjoyed it, please hit the notification button, like, subscribe, and watch more of our videos. Also, don't forget to share your comments in the comments section below. This is Finance Sense, helping you stay current on all the most recent changes in the financial markets and the economy. Stay safe and look out for the next video.